Hi, welcome back. Now that we've talked about why market efficiency or inefficiency is the basis of active investing, let's talk a little bit about how you test for market efficiency. At the outset, let's look at what a test of market efficiency would look like. You have a strategy, you're checking to see whether it beats the market. Effectively, you're answering the question, are the returns from using this strategy greater than the returns I should have made given the risk in this strategy? At the risk of stating the obvious, every test of market inefficiency is a joint test of both the strategy you're testing and the model that you're using to get expected return. So when you find an inefficiency, it could either be because you found something wrong with markets or because there's something wrong with the model you're using to come up with expected returns. I know that sounds like a problem that cannot be solved, but let's set it aside for the moment and let's talk a little bit about the benchmarks we use to assess whether you beat the market. The simplest and easiest benchmark is to compare what you make to an index. In the US, for instance, a lot of investors compare themselves to the S&P 500. They say, look, I made higher returns than I would have made investing in the S&P 500. Therefore, I have a good strategy, a money-making strategy, beat the market strategy. Not necessarily, right? Because when you take on a strategy, you also expose yourself to specific risks. And those risks are much greater than the risk in the S&P 500. Earning more than the S&P 500 might not be enough to beat the market. That's where risk and return models come in. We looked at the whole range of risk and return models in session 4 when we talked about equity risk. But when you're testing for market efficiency, you've got to bring those models into play to look at whether a strategy makes excess returns. And there are a variety of ways in which you can adjust. One of the oldest is called the Sharpe ratio. The Sharpe ratio, you take the return on a strategy and you divide by the standard deviation of returns in the strategy, and you compare that to what you'd have done as a passive investor, maybe on the S&P 500. An information ratio, very closely related. The only difference being that you look at excess returns and what's called tracking error, how much you deviate from the index. You can use CAPM-based measures of excess returns. Jensen's alpha, you look at the actual return you make on a strategy and the return you'd have expected to make given that strategy's beta, risk-free rate plus beta times a risk premium. The trainer index, again, very closely related. Look at the return on a strategy minus the risk-free rate, divide by the beta. You compare that to what that number looks like for the S&P 500 or something that you use as your passive alternative. You can use arbitrage models, proxy models. In effect, in all of these, what you're trying to look at is what you made on a strategy relative to what you'd have expected to make given its risk. And each might have variations, but generally most of them push in the same direction. You're asking the question, given the risk in a strategy, am I earning a return that's high enough to justify the risk and hopefully higher? So with that laid to rest, let's talk about the 3 forms of market efficiency tests you might run into. In an event study, you look at a particular event, maybe the Fed resetting rates, and say, is the market efficient about the way it reacts to it? An earnings reports from companies, is the market efficient about the way it reacts to it? With the subtext being, if it's inefficient, I can find a way to make money off that event. In a portfolio study, you look at a characteristic that you think will allow you to beat the market. Buying low PE stocks, buying stocks with low institutional investment, buying stocks with the founder is still the CEO. So in a portfolio study, you're trying to examine whether investing based on a characteristic can beat passive investing, beat the market. In an investor group study, you pick a group of investors, hedge funds, equity research analysts, and then you ask the question, do these investors beat the market? Do they collectively earn a return greater than you'd have earned by just being a passive investor? So let's look at structuring each of these different forms of market efficiency tests. In an event study, as we noted, you're looking at an event, an information event. And those information events can either be market-wide, like the Fed cutting the Fed funds rate, or it can be company-specific, an earnings report, an M&A announcement. And the objective is to look at whether that event triggers price reactions which you can take advantage of to make money. So let's set up an event study. Let's look at the sequence of steps you have to go through to test this? You have to start by specifying the event that you're testing. Sounds obvious, but you're going to see in a minute when I give you an example why this is so significant. It's got to be the event around which you trade. Then you collect returns around that event. X days before, X days after, X weeks before, X weeks out, or X hours before, X hours after. So basically you're collecting returns in the period before the event, the period after the event, the period of the event. And you get to pick how many weeks, months, days you go before or after. You adjust those returns for what the market did during that period. So if during one of those weeks the market was up 7%, then you have to adjust for the fact the market was up. And if your stock is riskier or safer, that's got to be factored in to get an expected return. So once you've got these excess returns, the difference in the returns you see and the returns you should have expected to see, then, and across a bunch of different companies that have the same event, you try to compute the average and the standard error across those returns on day minus 20, day minus 19. What you're looking to see is both statistical significance, which comes from your statistics X, with T statistics F, but as also economic significance. Is the difference large enough for me to exploit to make money? I know it sounds incredibly abstract, so let's take an example. Let's suppose, and this is a very old study that I'm going to point to, that your hypothesis is that when options are listed on stocks, remember options started getting listed on stocks in the 1980s for the most part, that when options are listed on stocks, it affects stock returns around that option listing. And we can talk about a lot of different reasons why. So the date we're talking about is the date on which you see an announcement that options are going to be listed. Why? Because you want to see what the effect of that listing announcement is. So the date is not when the options actually get listed. It's a date when the announcement is made that options are going to be listed. That's what I meant about being specific about what you're testing. Here I'm testing to see what the effect is of that announcement that options will be listed. Does it draw new types of investors in the company? I collected the returns in the 10 days before, the day of, and the 10 days after that announcement that options are going to be listed. Why 10? Why not? I mean, it's a choice you make. Why do you have to do multiple days? Because sometimes there might be spillover effects. You're trying to see whether there's trading ahead of the announcement, trading after the announcement. I also collected the beta of the stocks on which these listings were made to be able to come up with an expected return. So each of the 10 days, I looked at the return in the market in that day and using the beta came up with an expected return and then calculated the difference between the actual and the expected return. So let's say as an example, assume there were 100 companies where options were listed. They were listed at different points in time. So I'm collecting the 21 trading days around each of these listings and I have day minus 10 to plus 10 for each of the 100 stocks. Then I look at the average and the standard error on day minus 10, day minus 9, day minus 8 of the excess returns. Let's suppose the results look like this, right? The average excess return on trading day minus 10 was 0.17% across the 100 stocks on which options got listed. On that day, 10 days before the listing announcement, the average return is 0.17%, slightly positive. But before you get too excited, the T statistic on that is only 1.30, not statistically significant. And I track that every day, including day 0. Notice on day 0, there's almost no impact on the stock price. By the time the listing announcement is made, in fact, this is one of those events where the effect on the stock price is so small that you're scraping the bottom of the statistical barrel to find significance. With the 1.91, you can argue that the cumulative return across the entire 21 days is large enough that there might be some truth to the story that listing options on stocks is good news for stocks. Stocks price go up. But the effect is so small that you're struggling to attach statistical significance and you probably can't find any you probably won't be able to make money off this announcement either before or after the announcement. That's an event study. Later in this class, we will talk about M&A announcements, earnings announcements. The effects are much greater, but we're using exactly this strategy. So let's review. You're trying to test an event. You collect, the companies that are exposed to that event and the date on which the event happens, days before, days after, or weeks before, weeks after, or even hours before, hours after. And then you average out across the companies in your sample to get a sense of, is this a statistically significant event? Is it pushing my prices up, pushing my prices down, and making a judgment? Let's move on to studying a particular characteristic that you think you can use to make money. Low PE stocks, companies with low institutional holding. You're starting with a hypothesis that companies with this specific characteristic are more likely to be undervalued by the market. And you want to test to see whether that's true. So essentially, these are the tests you're going to use to look at whether any of the characteristics that people throw out as being good for companies is actually good in terms of actually making money on it. So the key though here is you want to make sure you're not testing the strategy on the same time period from which you got the strategy. What I mean by that is often we develop a hypothesis by looking at what's happening in markets. You're saying, oh my God, low PE stocks did really well over the last 5 years. You can't test whether low PE stocks beat the market using the same 5-year period that you observed that they did well. You have to have a holdout period. Again, sounds abstract, so let's take an example. The steps involved in doing a portfolio study, we're going to start by specifying the variable that we're going to use to classify companies. Low PE, institutional holding, you name your poison. Then we're going to create portfolios based on that with high values for that variable to low values. We're going to collect the returns in every firm in each portfolio. And we're going to estimate the returns and the risk of each portfolio over time. Again, correcting and adjusting for the risk and coming up with excess returns. We're checking to see whether portfolios with companies that have low numbers on this variable are different from companies with high numbers of the variable. Okay, converting abstract to practice, let's take a study on PE stocks. I mean, historically, people have argued that low PE stocks are good for investors. They make a higher return. To make a judgment on whether this is true, I went back to the end of 1987. I got the PE ratios for every company on the New York Stock Exchange. Already there's going to be a bias introduced because companies with negative earnings drop out of my sample. We'll talk about that later. That's part of the bias in the strategy is you lose money losing companies. So let's say 1,500 companies have PE ratios. And you can break them down, let's say into 5 groups based on the PE ratio, from stocks with the lowest PE ratio to highest PE ratio, 300 stocks in each portfolio. Then you collect the returns on each of these portfolios for the next 5 years. Now notice that because these are real companies, some of them might get delisted, some might get acquired. So you can't throw them out of the sample, you got to keep them in. If they're bankrupt, you might have a minus 100% return. That's the real world. And it's got to be incorporated into the returns in each portfolio. You compute the returns every year. You also have the betas for each stock of the portfolio computed from a pre-testing period. Again, you're trying not to contaminate your results by getting any of these characteristics from the period that you're testing. So you get them from pre-1987, 83, 87, and you adjust the returns on each portfolio for the risk in that portfolio. So you come up with an expected return of each portfolio, adjusting for the beta and the returns on the market each year, and you compute the excess returns in each portfolio. And here's what it'll finally look like. Lowest to highest, 5 PE ratio classes. For each year, I've computed the returns from the lowest, returns for the highest, and the differences. At least during this time period, the lowest PE portfolio earned about 4.56% more on an annual basis than the highest PE ratio portfolio. Now, if this were an actual study, I would show you T statistics to show you that that's statistically significant. And with that magnitude, it probably is. And then I'm going to throw it back into your lap and say, okay, you decide whether this difference is large enough, given your transactions costs, given your taxes, to go ahead and invest your money in low PE stocks. So again, let's review. If you're trying to check to see whether using a variable let you beat the market, you start with that variable, be very specific. And that's why you got to be careful about things like, I like companies with great management. You got to convert that great management into a measurable variable that you can use to create these portfolios. And then you check to see what their returns are over time based on the different classifications. and adjust for market risk? No. And once you do that, you can get a sense of whether this will allow you at least the basis for beating the market. Now, one of the limitations of the approach that I just described is you're classifying stocks on PE ratios into 5 classes. You're losing data when you do that. So sometimes people run regressions of returns or excess returns on stocks against PE ratios. The advantage of regressions is you have a continuous variation. You can take all of your stocks, you can look at variations, and you can quantify the effect of having a lower PE ratio on your excess returns. If that data was true, here's what you should see. Lower PE ratio companies in the regression had higher returns, and you can quantify how much that impact is. The advantage of regressions is you can bring in addition to PE ratio 3 other variables. I want stocks with low PE ratios and high growth and low risk, and you can run the regression across multiple variables and control for them. So the key in running a regression is you need an independent variable, something you're trying to explain. In the context of investing, it's usually, excess returns or returns. You need a whole host of dependent variables, and those variables have to be quantified. Even if it's things like good management, you got to find a way to make it quantitative. And before you run a regression, though, you got to run statistical tests, because standard regressions often assume linear relationships, where if growth doubles, the PE doubles, and that's not the way the real world works. So if you're careful with your statistics, regressions can be a useful tool as well to check to see whether a particular variable, whatever that variable is something driving excess returns. Final set of studies are studies of investor groups. And you're asking the question, is this group better than the rest of the market? Does it earn returns after adjusting for transactions costs and execution difficulties that exceed the returns you'd have made if you just put your money in an index fund? Yeah. So let's again look at the steps in examining whether an investor group is earning excess returns, whether it's beating the market. You have to start by identifying the group that you're focused on. It could be hedge funds, it could be mutual funds. You got to be careful to avoid survivor bias. Put simply, if you look at hedge funds today and work backwards and say, did these hedge funds earn excess returns over the last 10 years? What you're missing is the fact that a lot of hedge funds don't make it. And those hedge funds you'd have invested in as well in 2014 or 15, if that's when you'd made the investment. You have to measure the actual return on the funds. You've got to find a way to judge the risk that these funds are exposed to and calculate excess returns. So by now, you understand those steps, because this is something you see across all 3 kinds of studies. Take an example again. Let's suppose you want to see whether hedge funds beat the market. Go back and you look at all hedge funds that were open for investment in January 1st, 2014. Then you collect the returns on these funds, including the funds that failed, where you might put a return of minus 100%. That's to avoid the survival bias. Then you look at the risk in these funds, either based on pre-2014 data or even post-2014 data. And if you're using any of those risk adjustments, the Sharpe ratio, the Trainer index, you also adjust for the expected return you'd have expected to make on these funds given the risk. And you calculate the excess returns. Ultimately, the statistical test you're asking is, are those excess returns greater than 0 by enough for me to conclude that hedge funds beat the market? Later on in this class, we'll talk about what that excess return looks like for hedge funds. It's called an alpha, and sometimes reflecting some early studies, and we'll talk about the history of these studies. It's called an alpha, what those alphas look like for hedge funds and other subgroups of investors. Ultimately, though, if you're testing market efficiency, there are some sins you've got to avoid. One is using anecdotal evidence and settling for anecdotal evidence. Deciding that a strategy works because you tried it on one stock and it worked, and you've decided that to extrapolate from that. Second is to test a strategy on the same time period from which you got it. You're impressed by that strategy by looking at a particular time period. You got to test it on a different time period. Third is to avoid those sampling biases, right, which can creep in the most. We talked about in the context of PE ratios, and to show you how difficult it is to avoid, take the PE ratio test, right? You're losing those companies that are money losers. You are creating a bias in the portfolio. The question is how big, but please be aware of the biases. Failure to control for market performance. Finding that your strategy made 15% a year for the last 10 years looks impressive until I tell you the S&P 500 is up 25% a year for the last 10 years, right? You have to control for market performance. If your strategy is riskier or safer than average, you've got to control for those risk differences. And finally, to restate something that every statistics class tells you, just because you find correlation doesn't mean you have causation. Why does causation matter? Because causation might be what allows you to sustain these returns. You got to separate correlation, things that move together for no causal reason. They just happen to move together from things that move together because they're connected at the hip. Now, in terms of other sins, as the amount of data we have available to us increases, I think we're getting more and more susceptible to data mining. If you look at the data long enough and hard enough, you'll find ways of making money that definitely are not sustainable, but they look great. There's a survivor bias we talked about. That bias, to the extent that it's significant, can throw off your findings. So you've got to be very careful that you're not creating survivor bias. I'll give you a very simple example. If I took the companies in the S&P 500 and I said, our stock's good, and the way I'm going to test it is by taking the companies in the S&P 500, go back to their IPO date and looking at the returns you'd have made since, you're going to find excess returns. Why? Because how did you get into the S&P 500? By being one of the most successful companies, getting into the top 500 in terms of market cap. That's a survivor bias. Not allowing for transactions costs. We spent an entire session talking about the different dimensions of transactions costs. And here I make a confession. Almost every academic study that you see claiming to find inefficiencies is before transactions costs. So that's why so many papers look good, that so many research papers in finance claim to find market inefficiency, but there are so few people making money of those inefficiencies. And finally, there are some things that look great on paper again, but executing these strategies can be incredibly messy. So all of those factors can come into play when you think about market inefficiency. So let's summarize. If you are an investor, you're going to be hit with a lot of people selling you investment strategies. This is going to allow you to beat the market. And you're going to be easy prey if you fall for every sales pitch. So here are some questions to ask. First is, can you test this strategy? The answer is no. Steer far away from that strategy. That's why I said strategies such as invest in companies with good management. I'm not sure where to take that until you define good management. Second, can it be implemented? Strategy can be look good, but then you say, how do I implement the strategy? The answer is you cannot. Might as well give up on that strategy. Second, if the strategy can be tested, what is the test you would have to devise? And that's why I gave you the choice. Is it an event? Is it a characteristic that you can check with a portfolio study? Or is it a group of investors you're trying to follow? Does it pass the economic significance test? There are lots of things that are statistically significant that don't meet the threshold for can I make money on it? The excess returns are too small. And one final question, has it been tried before? One of the things I discover when I look at things that are offered as new and different in markets is almost everything that people claim to be new and different has been tried before. And the reason that's significant is it's often been tried and people gave up on it. Might as well find out why. Maybe things have changed enough that you can make money on it now. But has it been tried before? So in summary, I think to be an active investor, you at least need to figure out ways of testing investment strategies. And that requires a mix of getting comfortable with data, getting comfortable with statistics, and getting comfortable with setting up these tests in a way that you don't fool yourself. I hope you found this session useful, and I thank you very much for listening.